Everyone knows crypto's exciting, decentralized, the future. But there's one very centralized reality we can't ignore: the tax man. Today, we're diving into how the IRS isn't just, trying to keep up with digital assets. They're actually getting pretty sophisticated. Our mission here is to break down exactly how they're tracking crypto activity, pulling insights from the latest info we have. Let's unpack this.
Yeah, and it's really something. The IRS isn't just dusting off old manuals. They're using these cutting-edge third-party blockchain forensics platforms.
Okay, like what kind of platforms are we talking about?
Well, you've probably heard names like Chainalysis, TRM Labs, Elliptic, CipherTrace.
Right, Chainalysis comes up a lot. What do these things actually do, though?
So essentially, they use AI, they use blockchain scanners, and they try to link digital wallets back to real people.
Through the exchanges.
Exactly. Through that KYC, know your customer data that exchanges collect. They trace crypto from the source, even if it goes through mixers, DXs, or, cold storage. Plus, they monitor public wallet activity, like with Tornado Cash, and flag stuff that looks fishy.
Fishy like what?
Things like wash trades, those fake volume trades or rug pulls, and even just undeclared income from yield farming.
That sounds incredibly advanced. It feels like these tools give them a huge amount of visibility.
Oh, definitely. And it's not just the IRS. That's the interesting part. Other agencies, think FBI, U.S. Secret Service, they use these same platforms.
Wow. Okay, so that's the tech side. But you mentioned exchanges. How does the IRS get data directly from them?
Right, that's the other major angle. They have direct partnerships, sort of, and legal tools to compel data from the big U.S. exchanges.
You mean like Coinbase, Kraken?
Coinbase, Kraken, Crypto.com, Gemini, Robinhood, the main ones. They often use something called a John Doe summons.
John Doe summons? What's that?
It's basically a legal order demanding information about a whole group of users who meet certain criteria, not just one named person.
And this actually happens?
Oh, yeah. It's not theoretical. In just the last couple of years, 2023, 2024, both Coinbase and Kraken were forced to hand over thousands of customer records.
Records like what? Just names?
No. Wallet addresses, full trade histories, realized gains, the works. Plus, you've got the new tax forms coming in, like Form 1099-DA.
Right, the broker reporting.
Exactly. And the existing 1099-K for certain payments. The bottom line is, if you made over $600 in trades or income, and you did KYC with a U.S. exchange, well, the IRS very likely knows about it.
Okay, so they're getting data from third-party tools. They're getting it directly from exchanges. Are they also building their own internal tech, like IRS-specific AI?
Yes, absolutely. That's the third piece. They use their own automated bots and risk assessment engines internally.
What are those bots looking for?
They're programmed to flag unusual activity tied to your identity. Maybe you're active on decentralized exchanges, DEX, but it doesn't match your regular exchange filings.
Okay, inconsistencies.
Right. Or wallets that interact a lot with exchanges but aren't reported on your taxes. Or, huge gains that somehow don't show up on your form. 8949?
The form for sales and dispositions.
Correct. They also look for unreported airdrops, staking income, DeFi earnings, all that yield stuff. They're basically comparing your known wallet activity directly against your tax filings to spot mismatches.
This is pretty comprehensive. So looking ahead, what does this mean with new regulations coming online, like the ones from the infrastructure bill?
Yeah, that's where it gets even tighter. Starting potentially in 2025, those new rules kick in. Brokers, and that term is being defined broadly.
Right, could include DXs, NFT platforms.
Exactly. DXs, maybe even some wallet providers, NFT marketplaces like OpenSea, aggregators like Uniswap. They might all have to start reporting user trades directly to the IRS.
So almost every on-chain action could soon be reported like stock trades are now.
That's the direction it's heading. It really feels like for U.S. taxpayers, that perceived anonymity on the blockchain is rapidly disappearing.
So what are the specific red flags these IRS systems, these bots, are really zeroing in on?
Okay, based on what we know, here are the big ones. High risk. Not reporting any crypto income when they can see you have active wallets linked to you.
Makes sense.
Also high risk. Having DX activity that just doesn't line up with what you report from your centralized exchanges. Medium risk. Things like unreported airdrops, staking rewards, yield farming income.
And what about things like mixers?
Big red flag. Using mixers like Tornado Cash or Railgun gets instantly flagged as suspicious, possibly evasive, and things like NFT wash trading. That's treated like securities fraud, definitely illegal and audited.
Okay, this is a lot for people to take in. Given this level of surveillance, what can you actually do to stay compliant and, well, protected?
Good question. The advice is really about being proactive and organized. First, use crypto tax tracking software. Coinly, CoinTracker, ZenLedger. There are several good ones.
To keep track of everything.
Exactly. Download your transaction histories, those CSV files, from exchanges every year. Keep meticulous records of all your trades and file everything. Staking, yield, farming, airdrops. Even if the amounts seem small. If you realize you missed something in past years, seriously consider amending those returns.
Get ahead of it, basically.
Right. And honestly, strongly consider not using mixing services. The IRS systems are designed to spot that activity immediately.
What about just trying to fly under the radar, using non-KYC platforms?
Look, the reality is if you're a U.S. taxpayer, especially using U.S.-based services, hiding is becoming almost impossible. Non-KYC wallets and DATXs might offer a bit more privacy on the surface, but they're seen as much riskier by authorities if things come to light. The bottom line is the IRS has access to a ton of blockchain data now, and they're getting much, much faster at connecting those digital dots back to individuals.
So we've covered a lot of cutting-edge forensics, direct data feeds from exchanges, sophisticated internal AI. The IRS clearly has built a powerful surveillance network for crypto. It's evolving fast. It really leaves us with a big question to think about, doesn't it? What does this push for total digital financial transparency mean for our individual privacy? And maybe even for the future of decentralized finance itself, something for all of us in this space to consider.